Raja sir is live now.
Namaskar and very good afternoon and welcome to today's webinar, which is based on the topic ICDS in the inventory valuation and obviously the section 142(2)A under Income Tax Act, where the cost accountants have been entrusted with the activity of valuation of inventories. So this is a webinar as a part of the series of webinars which Tax Research Department under the guidance of Direct Taxation Committee has been organizing since couple of months, and in most of the webinars of this type of webinars, CMN Avneet Kumar Jain, our council member, has been the speaker and expert. And today with CMN Avneet Kumar Jain, we have got CMN Sri Ravi Kumar Shani. He is also a member of our Cost Accounting Standards Board of the Institute. So Saniji, we welcome you to our webinar today.
Namaskar. Namaskar.
So with this, I would like to proceed towards the webinar, main session of the webinar, and I request CMN Avneet Kumar Jain to take up from this.
Thank you, Rajat sir. Good afternoon to all the members who are present over here, all the attendees. I would like to welcome Ravi Sani ji, especially on this webinar, because I requested him, sir, we need your services, and he readily agreed immediately. Because now inventory valuation. Thank you, Ravi ji. Because I was his council colleague when he was a regional council member, and I have always got, you can say, his support always. That is what I can say. He has always supported in all the professional matters. Whenever we required, sir, we need to conduct any, you can say, seminar at a particular location. As a chairman, he always gave his consent, and we were able to do a lot of programs under his chairmanship. So I know he's a very good expert in inventory valuation. So I said, sir, we need your services also, because now the webinars and seminars are being conducted across India. We need more and more persons who can guide the members, because within few months, I think the inventory valuation assignments may start flowing in. And we should be ready with the, you can say, knowledge base, so that we can perform the inventory valuation well as per the requirement of the department. So, in fact, for the last few months, we have been conducting various sessions. We have apprised all the members about a little bit about what is Section 142(2)A. To start with, we will have a little bit discussion on Section 142(2)A, and then we will be focusing on ICDS 2 specially. Remember, because whenever we have to go in for inventory valuation, we must remember that we should forget each and everything, and we should focus on ICDS, relevant ICDS. There are different ICDS are there. And for, you can say, coming up with I would like to congratulate our TRD department also, which has helped us a lot in conducting various sessions under the, you can say, leadership of Rajat Basu sir. And we have come up with the, you can say, one guidance note on inventory valuation. And most of the members might have received, you can say, a mail in this regard from the institute, from our side also. I request all the members to give your inputs, so that the final document which goes for publication as a final one is in such a position that nobody should be able to object on any of the lines, any of the topics. It is there. It is under final, you can say, revision, and we have given it to the CBDT and the other income tax officers also to have a look. So my earnest request to all the members who are all the attendees. So please do spare some time, go through the inventory valuation guidance note, wherein specifically it has been mentioned that this is with regard to the, there we have given the, you can say, clarification with regard to the formats which are required to be filled up as per the Form 6D. So wherever you feel like that, okay, some more thing is required and some modifications are required, do let us know. While reviewing the inventory valuation guidance note, we should keep one thing in mind, that is specifically with regard to Form 6D. That doesn't include that how do we have to go in for a costing, because we being a cost accountant, we all of know how to go in for the costing, but certainly we need to keep in mind the relevant ICDS. Uh, while conducting the various, you can say, sessions, I have come across that many a times persons always tell us that we will have to go by the industry, we will have to go by the accounting standards. While going in for the inventory valuation, we have to follow all the cost accounting standards, whatever is there. Remember one thing, ICDS, relevant ICDS is of utmost importance when we are talking about tax computations. I do not want to get into the, you can say, nitty gritties with regard to the, you can say, whatever the inventory valuation which is being mentioned in the financials. Whatever they have mentioned, that is a different scenario. I was just discussing recently with a few corporate persons, and I said that normally what happens in the inventory valuation, I have seen always there are, you mentioned at the bottom line, you mentioned that some provision is there. And after that, you arrive at some value after deducting those provisions and show that in the inventory valuation. I said, if this is the thing that you are telling that, but that is not shown in any of the ICDS, that we have to exclude that. And I was really happy to know. Let me share with all of you. The person told that Noniji, while you can say while computation of tax, we exclude that provision from the inventory valuation and we take the full inventory valuation for the purpose of computation of tax. So these are the small things which we must remember while computing the, you can say, inventory valuation for the purposes of computation of tax, which will be reporting in various ITRs. I'll be starting with my session, and will touch upon some of the questions which might be coming to your mind. Uh, Let me tell you, we will not be discussing too much on section 142 2A, because we have already conducted various sessions on section 142 2A. Only a little bit brief will be discussed over here so that a continuity is maintained with regard to the ICDS 2 also. So we will try to link it with Ravi. Ravi ji will explain in detail. I'll summarize. I'll be giving you the brief bird's eye view. Then Ravi ji will go in detail, and then whatever the queries you have in your mind, my request to you, all of you, please keep on mentioning in the chat box. Both of us will keep on going through the chat box and will keep on responding accordingly during the currency of our session also. This is one thing I just wanted to state. And let me, you can say, share my PPT, and then we can start with that. One thing I just want to convey to all the attendees, our TRD chairperson, V. Murli, had specifically conveyed that we need to tell the audience that it is not that all persons will get empaneled with the income tax department. There are different type of criterias are there. Certain criterias are there. We will not be discussing in detail about the criteria, but one of the criteria is turnover, that is 15 lakhs, and plus one must be having some sort of experience in the cost orders or inventory valuation. That is one thing which is there. So I hope this is visible. If I'm not mistaken, it is visible. Rajat sir?
Sir, go for the PPT mode, sir.
Okay, I will go for the
Slideshow.
Not yet, Navneet, not yet.
Slideshow mode.
Okay, I have gone for a slide mode. Yes.
Yeah.
That's there now.
Yes, it has come.
Chaliye sir. So a little bit background, I'll be telling you that purpose of this inventory valuation by cost accountant is very clear. The department wants that there should be a different set of professionals who will be doing the activities with regard to the text computation, so that one has a check of his workings by the another. A very simple thing is that what happens when we have to go in for inventory valuation? What happens? We need to analyze the expenses and the different type of incomes also to arrive at the inventory valuation. And who are the persons who will be the financial auditor will be, you can say, giving the final figures, and we will be going in for using those figures for working out the inventory valuations. And inventory valuation, once this is finalized, these go into the, you can say, financials. That was the main thing. A circle is like this, that both things should be done simultaneously by two different departments in the long run. But as of now, one thing is clear, that background was that everybody knew that when we talk about inventory valuation, this was a weak link in the total, you can say, gamut of our finalization of financials. This is the weakest link because nobody used to check it practically in detail. Yes, because some of the financial auditors do check that. But what happened in most of the cases, some sort of management, by way of management representation or by way of a certain note, the responsibility was always shifted to the management of the organization. On the other hand, being a faculty member with the income tax department and having conducted hundreds of sessions, we were aware of one thing, that income tax officials also do not check the inventory valuation in detail. So only this aspect was brought before the authorities, and they know, because in present scenario, what is happening, all the expenses, all the incomes in most of the organized sectors, organized organizations, that is uploaded through GST. So only thing which was left is that inventory valuation where subjectivity was there. So it was thought that why not plug up this loophole also, and that is why it has been brought in. And luckily, because the inventory valuation area is concerned with the costing, that is why cost accountants have been given a preference over another professionals over here. So now it is up to all of us to work diligently, learn about it. So we know that all of us know how to go in for the inventory valuation, but we need to update ourselves, upskill ourselves, and ensure that whatever the inventory valuation we work out, as and when any order under section 142 comes up, it has to be as per the ICDS. It has to be as per the relevant sections of the act. We cannot uh, go here and there. We should be very specific with the terminologies which have been used in the ICDS 2. We need to know each and everything about the ICDS 2. So we will be discussing brief introduction, that we will be going in for very brief introduction. Relevance of ICDS. Let me tell you, in while going in for discussions, there are few ICDS, ICDS 2, ICDS 3, ICDS 8, which will be of much importance for all of us, because those are related with the inventory valuations. Apart from one or more, two ICDS will be there. Today we will be discussing only and only ICDS 2, nothing else, because that is straightway related to the costing of the product. So we will be focusing on ICDS 2 only in this session. Few general queries. Now, let me discuss with you the few general queries because whenever we have to go in for inventory valuation, so many things keep coming to us. What do we mean by ICDS? Income computation and disclosure standards. These were released by the Income Tax Department. I'm just briefing. Which ICDS applies for valuation of inventories? There are different type of ICDS are there, but primarily ICDS 2 is used for valuation of inventories for the manufacturing sector. Now, uh, which provision will prevail? If conflict between there is a conflict between Income Tax Act and ICDS. Income Tax Act is of prime importance, and whenever ICDS 2, or you can say, when we talk about ICDS 2 or INDES and AS2 is there, remember ICDS 2 will be there. We will be discussing about few exclusions in the next few slides. that where ICDS 2 will not be applicable and where another ICDS will be applicable. That has been specified. Next is what is the meaning of inventory as per ICDS 2? Remember, when we talk about inventory, we should be focusing on the definition of the inventory as given in the ICDS 2. So we need to update ourselves about what ICDS 2 tells about. Normally, if we go Index 2 and ICDS 2 are almost have same, many places have same terminology, but some differences are there where we will be discussing. What is the meaning of NRV as per ICDS 2? What is normally what happens, we always go by one thing that net realizable value means this is them. But remember, when we have to compute the inventory valuation as per the income under the Income Tax Act as per section 142(2)(a, NRV net realizable value, we have to be very careful about that how to go in for working out the net realizable value as mentioned in the income tax. We cannot have NRV at our discretion. Whatever anybody has used, we should not go for that, but straightway we should go to the definition which has been given in the ICDS 2 and then accordingly apply that. At what amount of cost of inventories should be recognized? When we talk about recognition of inventories, how much amount we need to, you can say, recognize in the inventory, whether total amount, partial amount, different type of inventories are there. We have to go in for working out the inventory accordingly. What are the inclusions while determining the cost of inventories? There are n number of inclusions are there. Those are also mentioned in the SDS 2. Remember, this is a few pager document and it encompasses each and everything what is required under the ICDS 2. While determining the cost of inventories, we need to, you can say, include my purchases, raw material purchases, cost of conversion. Within cost of conversion, we include cost of services also. And we need to, you can say, include all different type of components of cost when we have to work out the cost of inventories. What is purchase cost of inventory? Here, the one very critical question comes up. That what is the purchase cost of inventory? We're talking about any type of material if it has been bought, or any FG which has been bought up, any traded goods which have been bought, whether any taxes are to be included or not. There is a one example is there in the, you can say here, and these slides which Raviji will be taking up, we will be explaining it a little bit later. That though we will be under, we may have to include, you can say, taxes, but by way of memorandum account, ultimately impact comes to nil. That is why various guidance notes have suggested that we can go in for a exclusive method of inventory, purchase cost of inventory. For, you can say, we take various type of services for, you can say, conversion of raw material into goods, maybe job work or another thing. What is that cost? And different type of, you can say, service costs are there which we need to improve. What is cost of conversion? When we are using from raw material to, you can say, FG. I always repeat, cost of conversion, general definitions we do have, but we have to go by the definition which has been given in the ICDS 2. Remember, and what are the different components have been given in the cost of conversion, we should be aware of. What is normal capacity of production facilities? This is very, very important question because it is, because while computation of, you can say, inventory valuation, we need the cost of production, and for working out the cost of production, we need to know what is the normal capacity, because based on the normal capacity computations only, we have to go in for exclusion of certain fixed costs. So this is very important. We need to refer to the relevant ICDS to what is the normal capacity, whatever the definition of normal capacity is given over here. We should try to follow that only, and rather we must follow that only. Because sometimes we can see, I can tell you that in many of the places, it might have been mentioned that we can compute the normal capacity in a one manner, two manner, three manner. Let us forget all the things. When any special assignment under section 142(2)(a) comes up, remember whatever has been given in the ICDS 2 that we have to give, you can say, some sort of, we need to exclude certain sort of holidays, normal working days, whatever is given over there, we need to use that only. We will be explaining that. Now, what is the basis for allocation of fixed production overheads? So how that will be taken up? So this is, we need to include at what extent other costs included for valuation of cost. Other costs, well, you can say fixed overhead. Apart from fixed overhead, other costs are there, other overheads are there, variable overheads are there. Whether we have to include total or partial, obviously we have to include as per the production numbers. That is what we will be using. Whether interest and borrowing cost needs to be included in the inventory cost, primarily we know we don't have to include, but a specific clause is there in the ICDS 2. It tells that if a portion is required to be included, we need to include that. For that, we need to go to the relevant ICDS. ICDS 9 is there. I think I'm not able to recall that, but yes, one ICDS is there, 15, 16 or something. So we need to go to that and then we need to include. Which type of costs are required to be excluded when we have to go in for working out the inventory cost, like pure administrative costs are there, selling and display, selling costs are there. We don't have to include those costs while working out the inventory valuation. There are different type of methods are there in the inventory valuation, and we need to ensure that we go by the specific we go by the specific methods which have been mentioned over here. They are in the ICDS 2. FIFO and weighted average method have been mentioned. LIFO method is not there, so we don't have to use that. What are the techniques for the measurement of the cost of inventory? Different type of techniques are there that we will go through. And can we change the method of valuation of inventory if you want to change, but we need to mention the impact on the profitability of the organization if we are changing the valuation of inventory. And in and in case of dissolution of partnership firm, AOP or BOI, how the, you can say, inventory has to be valued. Primarily it is at NRV, so we will discuss on that. I'm coming to the specific provision of the inventory valuation. Just to maintain a continuity, we are discussing. I'll rush up through this particular session, a particular provision. We have already explained in detail many times. I'm just explaining it that if at look, section 142(2)(a) earlier only had one part. No, it has been split into two parts. One part is with relating to the special audit, and another part is related to the inventory valuation. But before part 1 and part 2, main section, what does it say? That at what point of time this will be required to be done. One, we should remember that inventory valuation, it is not necessarily that inventory valuation and special audit both should be ordered together. It can be either. It purely depends upon the assessing officer. What does he feel like? With the permission of seniors, this type of order can be issued either for inventory valuation or for special audit or for both. This is very, very important, which all of us need to understand. And at what time, if at any stage of proceeding before him, at any stage of proceedings before him, when he is assessing, reviewing everything, whatever he is doing, assessing officer, and there are different criteria, nature and complexity of the accounts, volume of the accounts, correctness, he feels that records are not correct, he has asked for certain information is incomplete, or the documentation is huge, multiplicity of transactions, lakhs and lakhs of transactions are there, is not able to comprehend that how the inventory valuation can be there. If there is a specialized nature of business activity which the person is not aware of, and due to the specialized nature of activity, some sort of professional expertise is required. Most importantly, in the interest of revenue, then he can request for this thing. If he is of the opinion, he may, with the approval of previous approval of four category of issues are there. That is PCC, Principal Chief Commissioner, CC, Chief Commissioner, PC, Principal Commissioner, and CIT, Commissioner Income Tax. With the prior approval of him, he can direct the assessee to undertake two things: to get the accounts audited by an accountant, so and so, to get either or both of the filings specifically mentioned. And main part is that to get the inventory valued by a cost accountant, inventory has to be valued by a cost accountant nominated by who will be nominating him. It will be nominated by Principal Chief Commissioner, Principal Commissioner, or Commissioner in this behalf. Anybody can nominate the Commissioner. However, this nomination will be from a panel, which I hope most of the members who are attending this, they might be aware of that many states have, you can say, already issued the, you can say, empanelment notice for inventory valuation for cost accountants. And I request all of you to just go and apply. Whosoever falls fit into the criteria, one must apply over there. And he has to furnish a cost accountant will be required to furnish a report of such inventory valuation in the prescribed form. Whatever report of inventory valuation, that is a Form 60. And with regard to that, I had earlier said that a guidance note has already been released. That is a purely a draft. For that, comments have been invited from all of you. I'll request that whosoever feels like can go to the institute's website, find out, and you might have got on your mail also. And then please submit your suggestions also there. And furnish a report of such inventory valuation in the prescribed form. Prescribed form is Form 60, duly signed and verified by a cost accountant. The way we are signing and verifying the cost report, same format is there. Setting for such particulars as may be prescribed. That setting for with such particulars as may be prescribed in the Form 60. Most important, never ever forget that it has to be as per the other particulars as the assessing officer may require. Whatever the assessing officer require, that has to be additionally given by the cost accountant. One very important thing is that opportunity of being heard has to be given specifically to the person whom the income tax department wants to bring in this thing. I'm moving ahead that Section 144A. What if the assessee does not respond to order under Section 142A? The assessee officer is under an obligation to make an assessment to the best of it. We need to understand this provision because whenever we are going in for a, we have already experienced that whenever any special audit order or any special assignment is like inventory valuation is given, normally what happens, we do not receive the data. And if we do not receive the data, the things stuck over there. But here, income tax officers are vested with the powers to go in for a best judgment assessment. So remember, this will be to the, you can say, detrimental to the person who is not cooperating. So we need to tell these things to the assessees also. Any questions till now? Let me see if any queries are here. Sir, Rajat sir, are you here? Or ma'am, anybody from the TRD department?
Yes, sir.
Any person?
Yes,
Ma'am,
sir.
I think chat box has not been released. I think chats are have been put on hold. We are not able to view the chats. Just see to it.
Just a minute, sir.
Because
Sir,
yeah,
you
please see.
click on the Q&A option.
Q&A. Okay, fine.
Yes, sir.
Okay, fine. And these are required to be published or not?
Sorry, sir.
These are required to be published because one thing is coming up, publish.
Yes, sir.
So you can publish it now so that other members can see.
Yes, sir.
If anybody is having, you can say, if there is a echo problem in whatever I'm speaking, because one person has stated that there is a echo issue. Is it so? or am I audible fully?
From our side, it is okay, sir.
It is okay, na?
Yes, sir.
Fine. Is there any network issue? So somebody has stated to him. Okay, fine. And till now, what is the criteria for a proprietary practicing CMA? Look, even proprietary practicing CMS are also allowed. We will discuss on these parameters a bit later once we are over with this ICDS 2. Then we will be discussing on those. What is the specific requirement? Yes, Srinivas Reddy ji, very good query. Sir, when AS2 is there, what is the specific requirement of ICDS2? This is what we have been explaining repeatedly. Remember, ICDS2 has been released by the Income Tax Department, and the organizations have to follow that only. Remember, so please remember one thing. I always keep on repeating one thing. We need to follow ICDS2. We need to follow ICDS2. Even if you go for you undertake any special assignment and any this assignment of inventory valuation, go to the organization. Our organization tells that it has followed ICA Index 2, AS2, cost accounting standard. We should say everything will come later. First of all, he needs to tell you that whether ICDS relevant ICDS has been followed or not. And primarily for all manufacturing concerns, ICDS 2 will be there. So we need to be very clear on that. Srinivas Reddy ji, I have answered your query. Now CMA Karthik Gavani ji. The criteria regarding empanelment is extreme in itself, so that majority of CMS cannot get empaneled. Some conditions need to be revised by the IT department. Karthiji, we had a detailed discussion with the principal chief commissioners. I personally had you can say discussion with the different principal chief commissioners, and it was stated that already the criteria is very relaxed because it is not very high. On the one hand, we are talking about you can say having a very good amount of fee, and on the another hand, we are talking that we just expect that turnover criteria should be lowered. And one thing is there, the areas where you feel that professionals will not be there having that particular turnover, they can approach the principal chief commissioner. They may relax. Discretionary powers are with them. But I have already spoken to 3 principal chief commissioner, and nobody has relaxed this condition. It will be purely dependent upon the respective chapters or respective regional councils, the persons from there, they should go meet, local chapters should go and try to convince upon that, okay, try to reduce the criteria. Wherever the empanelment notices have not been issued so far, till date only at very few, I think Guwahati, Bhubaneswar, Lucknow, Delhi, Nagpur, Pune, and Hyderabad and Kochi. I think these areas, you can say, empanelment notices have been issued. So at other places, person can approach the department. So this is what I just wanted to say. Now I'm going back to my PPT. So this is what I have already explained. And regarding fee, the fee will be paid by the government, income tax department. Now ICDS. Now I'm focusing on ICDS. Look, by way of a notification, the government of India, CBDT, notified the income competition and disclosure standards to be followed by all assesses. I hope, Mr. Reddy, your answer lies here. By way of a notification, mandate has been given to all the assesses that they have to follow this thing. Other than who don't have to follow, there are few persons who are not required to follow ICDS. They are the persons who are not required to get their accounts audited in accordance with the provisions of Section 44B. No tax audit is not there. They need not follow this thing. Second, If the organization is following cash system of accounting, there also ICDS 2 is not required to be followed. And it will be, you can say, to be followed for the purpose of computation of income chargeable to income tax under the head PGBP or income from other sources. Profit and gains of business or profession and income from other sources. For other incomes, if the organization is having income from any other head, he need not follow ICDS. It is amply clear from this particular ICDS compliance. Notification, this notification will come into picture from assessment year 2016-17 and subsequent years. Now, there are different accounting, you can say ICDS are there. One is on accounting policies. We are restricting ourselves to valuation of inventory. And third one is construction contracts here also, where the organizations are into, you can say, real estate, construction, building of the, you can say, complexes, etc. They have to follow this thing, and that for the valuation of inventories also. Remember, for valuation of inventories, they have to follow this thing. And number 8 is with regard to the securities. If the organization is dealing into the securities, it has to follow that one accounting standards. I'm not touching upon that another cost accounting standards. One quote is there that certain accounting treatments which were used as a base for computing taxable treatment cannot be taken for granted and must be re-evaluated from an ICDS perspective. This was a one comparative report wherein it has been given that that was by Deloitte, and I have taken few slides. We have taken few slides from there also. So remember, from ICDS to perspective, they have to be re-evaluated. Now, this ICDS 2 is there. After that, I will take 1 or 2 slides, and after that, Ravi sir will take up. In ICDS 2, when we go to the ICDS, we need to go to the preamble, which has not been mentioned over here. Then different definitions are there. Whenever we need to understand any, you can say, act or any rule, we need to go through the definitions firstly. What does the definition? What do we mean by you can say inventory over here? What is included in the inventory for the purpose of ICDS 2, and what is its scope? What is excluded from this ICDS 2? Then how to measure the inventory? And then you can see there cost word so many times it has come. That is why cost accountants are there in the inventory valuation. Cost of inventories, cost of purchase, cost of services, cost of conversion, inclusive of cost of conversion is inclusive of your, you can say, cost of services and another conversion parameters. Other costs are there. Exclusion from the cost of inventories. What are the items which are required to be excluded? Non-cost items we all of know, which do not, you can say, go for the final production of the products, which do not form part of final cost, which will be required to convert the raw material into final product. Those are excluded. Different type of cost formulae have been given, and you can say two methods. I had already told that two methods are there. First in FIFO and weighted average. LIFO method is not here. What are the techniques for measurement of cost? So Raviji will explain in detail. Remember here, NRV has been stated specifically. What do we mean by NRV? And especially when we talk about NRV with regard to the WIP, we should be very, very clear on this. Based on my experience, I can say with conviction that NRV of the WIP is not followed normally by the organizations, and this will open up Pandora box sooner or later. That is going to happen. NRV with regard to normally and with regard to the, you can say, WIP items. Value of opening inventory. We had a detailed discussions that how to, you can say, go in for value of opening inventory in case of a new business, or in case of you can say business which is was there in the last year. Obviously last year closing balance will come as an opening inventory, and if it is a new business, whatever is my cost of acquisition, that will be my opening inventory. But one very important thing is there. When I'm getting an assignment in the under section 142(2)(a), do I have to value inventory again, opening inventory, or I have to value closing inventory? So there we have to value only closing inventory until unless we are given specific instructions to value the opening inventory. Change of method of valuation of inventory I just discussed, and then value of inventory in case of certain dissolutions, NRV is required, that is there. So few of the disclosures are required. Preamble, I'll discuss. Raviji, I'll discuss this, and then I'll go to the next slide, and then I'll request you to take over. Ravi sir, are you there?
Yes, okay. Yeah.
Yes, next slide, and then you can take over.
Sure.
So preamble. So this is what we have already stated, that this I have already discussed, that it is applicable for, you can say, computation of income under that PGBP and income from other sources, and not for the purpose of maintenance of books of accounts. Remember, clarified. When we talk about AS and INDES, they talk that, okay, that is for the maintenance of books of accounts. When we talk about ICDS 2, it is for the purpose of computation of tax practically. However, there are not much differences. Some differences are there, which will be discussed by Ravi sir. In the case of conflict between the Personal Income Tax Act, we have told whenever act, rules, or any other, you can say, standards are there, always and always, whatever the provisions of that are there, those sustain. Inventories are assets. So these two things I'll be discussing. Inventories are assets held for sale in the ordinary course of business. Normal, nothing you can say you have procured, you have manufactured something, you are into trading of business, you have held those for the purpose of sales, that is there. Next one is in the process of production for such sale. That is our WIP. When we talk about WIP, I have already told this is a major area cause of concern for every organization. Major area of concern, this is a major area of concern for the income tax authorities, but certainly for the, you can say, all the professionals, this should be an area of concern, and organization must mend their ways. Let me tell you frankly, going by my experience of more than 25 years, I can say with conviction that we need to change. The way new rules and new regulations come up, the organizations must change the ways to suit the regulatory environment. So regulatory environment has got changed so far as Income Tax Act is concerned with regard to the inventory valuations. The attendees who are there, I'll request them to please check your inventory valuations in the light of the Form 6D, whether we will be able to, you can say, provide the data which is required over there, and whether whatever the inventory valuations you are doing, whether those are complying with ICDS 2. Though till date everybody used to tell that, okay, in the Form 3CD, specific disclosure is required to be maintained whether there is any deviation of in the inventory valuation as per books of accounts, as per ICDS 2 is there or not, and everybody used to write no. Nobody used to check that, and that used to pass on like anything, but not anymore. Now one has to be very careful. Please, please try to have a detailed checklist of ICDS 2. Try to get that implemented in your organization, because tomorrow, if any tax officials or any of the special person who has to conduct the inventory valuation comes calling for the details, whether the organization will be able to provide those details. And as a professional, if I am given the task, am I aware of what are the, you can say, different type of, you can say, parameters in the ICDS 2, what type of inventories will be there? And inventories are assets held in the form of materials or supplies to be consumed in the production process or in the rendering of services. For both, whatever the materials you have or supplies the organization has held for the purpose of the for the purpose of consumption, for the production process, or for renting of services. Exclusions are there. 4 exclusions are there. 5 exclusions are there. WIP construction dealt by ICDS and construction contracts. It will be separately that today we will not be discussing it. WIP which is dealt by other ICDS, it is not available. What are the other ICDS are there? Any WIP which is being dealt by other ICDS, not clarified anywhere. Shares debenture held as stock in trade dealt by ICDS on securities. If I'm a share broker or something, I'm dealing in, you can say stocks only, stock means shares, etc., share debentures, etc., then it will be valuation will be dealt by ICDS and securities. Producers' inventories of livestock, agriculture, and forest products. Again, it is not there. To the extent they are measured at their net realizable value. If they are not measured at their net realizable value, or if the person who is holding this inventory of livestock, agriculture, and forest produce is a trader only, then ideally ICDS 2 will be applicable, not any other, it will not be as a net realizable value. For machinery spares to be used only in connection with tangible fixed asset and irregular, and wherever there is an irregular use of, you can say spares, etc., it has to be, you can say, worked out as per ICDS on tangible fixed assets. I have given you a prima facie, very summarized, you can say, view of for this. I'll request Raviji to take over. Raviji, should I stop sharing and you will upload yours? Ravi sir?
I'm using the same presentation, so I'll continue from where you have left now. So
okay,
I'm sharing now.
Should I stop sharing? Yes, I'm stopping sharing. You can.
Okay, yeah.
You can start talking. My again request to all the members who are over here, please, you can say, mention whatever the queries are there. We will be taking up those queries.
Is it visible now?
Yes,
My
sir.
screen.
Yeah.
Yes, it's visible.
Ravi sir, 2-3 questions.
Yeah.
Here, cost accountant means practicing or not practicing. Here, cost accountant means practicing cost accountant only.
Okay.
Some anonymous, you can say, is there, query was there. Next one is ICDS override cost accounting standards. So Dayaji, very good question. They have to be run parallelly, but ICDS will certainly prevail over cost accounting standards if there is any inconsistency between the two, which will be applicable for inventory valuation. One again question we are repeatedly telling, because this is a misnomer that AS2, Indus2, CAST, our cost accounting standards, they will prevail. Let me tell you, ICDS2 will prevail. Wherever any, you can say, difference is there, ICDS2 will take the primacy, and otherwise both all different accounting standards run side by side. This type of cost can be included in intermediate. All the costs which have, you can say, by way of which the inventory has reached up to that level. Opportunity of being is the slide that we see. Okay, fine. Now, okay. Ravi sir, over to you.
Okay, thank you very much, Navneet ji, and I really congratulate you for a very exhaustive explanation of the provisions of section 142(2)(a) for valuation of inventories by cost accountants. As generally speaking, we all are cost accountants. We know how to do the valuation of inventories, and the ICDS, as is being questioned by many of our members, that when the AS2 was there, then where should be a need for the ICDS2? So this is, I think, has been explained by Navneet ji, that this ICDS is not meant for the preparation of accounts or presentation of accounts. The purpose here is very different. It is only for the valuation of profits under two heads, that is business income and other sources income. So likewise, you know that the accounts are prepared using the Ind AS and AS2. And when it comes to the computation of income or computing the tax liability under the Income Tax Act, then the one statement is prepared for computation of taxable income. I think to that extent, this standard would be relevant, wherein the department's intention is to ensure that the proper taxes are being collected, the fair income is being shown as a taxable income, and fair taxes are collected by them. So long, so forth, this will hold good. So now let us go move on. Is my screen visible to all, this presentation?
Yes, sir.
Yeah.
Yes, visible.
Okay.
So
Now,
you can put that to slide mode.
Okay. Right, I'll do that. Is it done?
No, sir. I will just wait. Pop up.
Sir, you please show your PPT, sir.
Sir,
Okay.
Alt tab. Use Alt tab, sir. Show your PPT. Sir,
Yes.
click at the bottom. So click at the right bottom, na. That slide. Yes, sir. Left. Yes.
No,
Yes.
no, you want this PPT mode now?
Yes, sir.
Just click.
Perfectly right. Perfectly right. So again
Okay.
gone. Again gone.
Gone? Okay, no worries. It will be back.
Yes, sir. Perfectly right, sir.
Okay.
Right, sir.
Now coming to this ICDS 2 inventory valuation, because there are few points which are very catchy as we go through this inventory valuation standard ICDS 2. One is net realizable value. Now, net realizable value is defined as the estimated selling price, which is otherwise also we know what is the net realizable value. But for the sake of clarity, this has been explained as is the estimated selling price in the ordinary course of business. Now, important here is to note the ordinary course of business, because this realizable value treated is differently. It is differently treated in the ICDS 2 in certain cases. We will discuss what are they in the coming slides. So ordinary course of the business is where the business is going on as a going concern. For example, wherever there is a change in a partnership, the firm is actually under dissolution or under recreation. So the partnership, in that case, the valuation of inventory will be done on a different basis. So there are certain points where we have to be very careful while doing the valuation, because the ultimate objective is to meet the valuation in pursuance with the ICDS 2 inventory valuation standards and not any other standard. So we may be guided by the principles of AS2, Ind AS, or maybe also our cost accounting standards. But as is already conveyed to you by Navneet ji, that wherever there is a contradiction, the ICDS 2 shall prevail over all other standards or other provisions. So measurement here, inventory shall be valued at cost or NRV, whichever is lower, which is the same as AS2 and other standards that we follow, except the cost accounting standards. Cost accounting standards, though, we don't have any specific standards on valuation of inventory while we were discussing this aspect in our CSB also. The institute is even thinking of bringing out this standard on valuation of inventories, because now it has become very important with this ICDS 2 coming on inventory valuation. But generally speaking, as per we are guided by the company's cost audit and record rules, which generally requires us to the valuation at cost only. So whenever we do the valuation in cost records in the cost statement, generally we do it on the basis of historical cost using the absorption costing method, which is also given as a method in the AS2. Now coming to the cost of inventories, what shall it comprise of? The inventories cost shall comprise of all cost of purchase, that is the purchase cost of the inventory. Cost of services. Now this is what is cost of services we will understand in detail in the coming slides. And in case of manufactured inventories, it must include the cost of conversion. So this conversion cost is already known to us. And we are doing our valuation basis the conversion cost for each of the product which is manufactured. So this we are already doing. Now coming to the other costs, it means that all other costs which are incurred by the SSE in bringing the inventories to their present location and condition. So this more or less we understand well that what is meant by the other costs which are incurred for bringing the inventories to their present position or condition or location. We will discuss these in detail in coming slides. Now coming to the cost of inventories, when we say cost, it is basically cost of purchase or cost of service, or in case of manufactured, cost of conversion plus other costs that are incurred. Now other costs incurred means the same which I have discussed in the previous slide. Now let us go one by one. What do we mean by cost of purchase? The cost of purchase shall consist of purchase price including duties and taxes. Now this is the first point of differentiation that we have. Generally speaking, we are following whenever we are doing costing, we are following the exclusive method. Exclusive method here means that we don't generally include the cost of duties and taxes which are available to us as a credit. So these are cost neutral basically to the SSE, because whenever he is paying the taxes, he is not incurring any cost, and whenever he is recovering, he is not making any income out of it. So we consider that as a levy which is collected on behalf of government and it is repaid to that government. But ICDS 2 is having the first point of differentiation here, that where it prescribes that the cost of purchase has to be inclusive of duties and taxes. We will show how this is to be included in the coming slides. It talks about the freight inverse, which is to be included as a cost. We are also including that as a cost. No worries on that. Other expenses directly attributable to the acquisition. Now, more or less, this is also clear, but coming to this question as to how to determine directly attributable to the product. So it means that there has to be a one-to-one correlation between the cost incurred and the product on which such costs are being allocated or assigned. So the nexus should present between the two. I mean the expenditure incurred and also a clear linkage with the product on which that cost is being loaded or charged. So the onus of proving or refuting this would be on the shoulders of the SSE. Trade discounts, rebates, and other similar items shall be deducted in determining the cost of purchase. While we do the purchases, we get some discounts, we get some trade discount, we get some cash discount, we get some rebates, we get some volume discounts also. So these shall be deducted in determining the cost of purchase. The idea is to arrive at the net cost of purchase of the inputs that you are sourcing. Now, coming next, what do we mean by the cost of purchase? Now, the cost of purchase here means the ICDS prescribes inclusive method, while the accounting standards, as I said earlier, prescribes the exclusive method. Now, what do we mean by inclusive method? Inclusive method means a method for calculating the income under the profit or gain from business or profession by including duties and taxes, including recoverable. Now, this is in contrast with what we have been doing in general practice. Now, exclusive method means that a method for calculating the income under the profit or gains from business profession by excluding duties and taxes, which are recoverable in nature. Now, let us see how it happens. Accordingly, if an exclusive method is followed for the purpose of valuation of inventory, as per the accounting standard, the taxpayer would be required to prepare the memorandum account to demonstrate that vis-a-vis inclusive method, it is tax neutral. It is not actually disturbing the tax compliance or the tax incidence. For detailed understanding, please refer this example which is given. Messrs Computer Networks has purchased 4 items at the rate of 3 lakhs each, exclusive of GST at the rate of 5%. Suppose during the year, GST on purchases is at the rate of 5%, 3 are sold and 1 is balance as an inventory. And these 3 are sold actually at the rate of 4,20,000 each. and GST on the outward sale is 5%. Now, in the exclusive method, which is generally prepared as per AS or Ind AS, we will have the P&L account for the prepared for the financial year as under. We will debit purchases at 4 items at the rate of 3 lakhs. So this will give us a total value of inventory purchases 12 lakh rupees. Sales, we have made 3 items numbers we have sold at the rate of 4,20,000. So this gives us the amount of 12,60,000. Now comes to the valuation of inventory, as we know that it will be valued at lower of cost or realizable value or NRV. Now in the instant case, the NRV is higher and the cost is lower. NRV is 4,20,000, whereas the cost is 3 lakh rupees. So we will do the valuation at the lower of the two, that is cost price, which is 3 lakh rupees. Now 3 lakhs rupees becomes the inventory value, and this gives you a profit of 3,60,000. This is how we do the accounting as per accounting standard and Ind AS. Now let us see how it will be done in ICDS. Next slide. Now in this ICDS inclusive method, our purchases will be 4 items at the rate of 3,15,000. Why 3,15,000? Because the original price was 3 lakh rupees, but there was a GST at the rate of 5%. So this gives you a tax of 15,000. It will be added to that, and the total cost of purchase would be 12,60,000 as against 12 lakh. Because 3 lakh rupees, and you can add 3 into 4 is 12 lakh, 12 lakh 5%, 60. So this gives you total debit of 12,60,000 rupees. Now coming to the sales, since the inputs have been valued inclusive of tax, the sales will also be valued inclusive of tax. So the sale price will be for 3 items at the rate of 4,41,000 as against 4,20,000. This includes 5% tax. So rate is 4,41,000. As output tax is given in the table below, one cutout is given. Output tax is calculated 4,20,000 for 3 items. So multiplied by 5%. So this gives you a tax of 63,000. So the difference between 1323 and 12,60,000 is actually 63,000. Now coming to the valuation of closing stock here, the closing stock, unlike the earlier method, since here we are valuing all the inputs and outputs inclusive of tax, so closing stock will also be valued inclusive of tax. In the earlier method, we have valued the closing stock at 3 lakh rupees. Here we will do this at a cost 3 lakh rupees plus 5% tax, that would be 3,50,000. Now just to do the adjustment entries for taxes, what we will do is that whatever GST we have paid on sales, it will be debited, that is 60,000, and whatever tax we have paid and recovered on purchases, that is called input tax, utilized on COGS, that is 45,000. Remember, we have COGS for 3 items because 3 items were sold and 1 was kept in inventory, and the tax on input tax on 3 items comes to 45,000. So that we have credited. So this gives us a profit of 3,60,000. In the earlier system, we have the same profit. So this memorandum P&L account that we have prepared, that is showcasing that whatever method we follow, it is tax neutral. It doesn't impact the profitability to the assessee. This is mere a difference in the presentation of the two values in the two different systems. Now coming to the cost of purchase, instead of revising the whole P&L account, we generally prepare simple memorandum account. Now this is the same presentation which is showing the increase and decrease in profit. And you can see that at the end of both the columns, increase in profit and decrease in profit, it nullifies each other. So again, there is no impact on the profitability. This is the purpose of actually preparing this memorandum account. Now, coming to the cost of service, the cost of services shall consist of labor, other costs of personnel directly engaged in providing the service. Now, here comes the problem, or maybe you can say the challenge. Because here they are expecting that other cost of personnel, the term they've used is directly engaged in providing the service. It means a one-to-one correlation has to be present between the cost of the personnel that the organization is bearing and the services they are providing to a particular product or activity. So this one-to-one correlation should be present to actually allow these costs to be included into the cost as cost of service. So this cost generally will include the supervisory personnel, their cost, and attributable overheads. Now again, a challenge comes in the form of what do we mean by attributable overheads and how do we determine these overheads? And this is the challenge that we have. So we'll have to understand how do we actually decide on these factors. Now, coming to the cost of conversion, the cost of conversion of inventories generally should include the cost directly related to the units of production and a systematic allocation of fixed and variable production overheads. Now, please be informed that nowhere the detailed explanation of fixed and variable production overheads has been given the way it is given in our standards. So we can be guided by our cost accounting standards for that matter, but there is no reference, given in these ICDS as to how you follow it, and you have to actually follow and restrict yourself to the definitions which are given in the ICDS. If something is not given in the ICDS and it is not contradictory with the objectives of the ICDS, then only you should refer to the external sources, because a clear reservation has been made in beginning itself that if anything goes wrong, if anything goes contradictory, then the provisions of ICDS shall prevail over any other method that has been followed, or any practices which are inconsistent with the provisions of ICDS, the ICDS provisions shall prevail. Now, coming back, a systematic allocation and fixed and variable production overheads that are incurred in converting the materials into finished goods. I think this is the same terminology, same understanding we are having, and we are guided by these principles only while we do the valuation of inventories in our cost records. Fixed production overheads shall be those indirect costs of production that remain relatively constant regardless of the volume of production. This is a general explanation of the fixed production overheads. We know that which remain fixed, irrelevant with the having no relevance with the level of activity, regardless of the volume of production. Variable production overhead shall be those indirect costs of production that vary directly or nearly indirectly or nearly directly with the volume of production. Means nearly directly means that they may not change in the same proportion as with the level of activity, but they still change. For example, we would understand this better by having the concept of semi-variable costs. So semi-variable costs have the same relationship, same nature. For example, level of activity is increasing by 30%, but the cost might not have increased by 30%. They might have increased by a lesser number, say by 20% or 25%, 10%. So the difference being the fixed cost component involved. So these are essentially semi-variable overheads. I think we have understood this concept. Now, allocation of fixed production overheads for the purpose of their inclusion in the cost of conversion shall be based on the normal capacity of the production facilities. So they have also explained what is the meaning of normal capacity, which is incidentally the same which is explained in our cost accounting standard 2, which is about the capacity determination. So you will find more or less the same chronology they have followed, same explanation they have adopted here. Normal capacity shall be the production expected to be achieved on an average over a number of periods or seasons under normal circumstances, taking into account the loss of capacity resulting from planned maintenance. So this is what we do generally, that whatever capacity we consider as normal, this is a capacity which a company is expected to achieve over a number of periods, normally usually 3 to 4 or 5 years period, or over seasons in case of a seasonal industry under the normal circumstances. Normal circumstances means that something abnormal has not happened during that period. For example, no floods, no natural calamities, no major breakdowns, unexpected closures like Corona recently came. So these are the abnormal situations. So considering the normal circumstances, taking into account the loss of capacity, which is from the planned maintenance, because planned maintenance is allowed it is allowed activity, normal cost. So we can reduce that from calculation of normal capacity. The actual level of production shall be used when it approximates to normal capacity. Now, this is again a concept which is given. They say that as per ICDS, if their actual production is close to, or it is approximately close to normal capacity, the actual level of production shall be used for the allocation of cost. The amount of fixed overheads. But if you will go through our, in contrast, if you will go to our cost accounting standard 2, read with cost accounting standard 3, which is about allocation and apportionment of overheads and costs, you will find that different methods of allocations have been provided for allocation and apportionment of fixed and variable costs. So these are in slight, I would say, change or contrast with what is being provided in the ICDS 2 for valuation of inventories. The amount of fixed production overheads allocated to each unit of production shall not be increased as a consequence of low production or idle capacity of plant. Now, what do we mean by this? The fixed production overheads allocated, I'm reading it again for your convenience. The amount of fixed production overheads allocated to each unit of production shall not be increased as a consequence of low production or idle plant. Does it mean that the non-utilization of capacity or due to low production, low demand or idle plant should be excluded from being a part and parcel of the valuation of inventories? For example, if during a period the capacity utilization has been substantially low due to low production for whatever reason, or plant running idle due to this reason, the fixed cost attributable to that level or volume of production should not be loaded onto the production quantity which has actually taken place during the year. I think this is the same practice that we follow if we read it out with the CAS 3 read with CAS 2, that is determination of capacities and allocation and apportionment of overheads. So same thing, I think no contradiction here. Unallocated overheads shall be recognized as an expense in the period which they are incurred. Now, what does it mean? Unallocated overheads shall be recognized as an expense in the period in which they are incurred. Does it mean that they will be allowed as a part of cost? So again, here is a confusion on this. In period of abnormally high production, the amount of fixed production overheads allocated to each unit of production is decreased so that the inventories are not measured above the cost. Variable production overhead shall be assigned to each unit of production on the basis of actual use of production facilities. I think again this is in line with our cost accounting standard 3 that we follow. Cost of conversion includes, I think this we have covered, fixed and variable. I think this is a repetition of the slide. I think the last line we can read out: the allocation of fixed production overheads for the purpose of their inclusion in the cost of conversion shall be based on the normal capacity of the production facilities. I think this is also fine, what we practice in our cost accounting. I think this is again a repetition, except for the third point. Unallocated overheads shall be recognized as an expense in the period in which they are incurred. In periods of abnormally high production, the amount of fixed overheads, production overheads allocated to each unit of production is decreased. I think this is the same we have read earlier, so that the inventories are not measured above the cost. So again, it is talking about the unallocated cost or unreasonably high production cases where the production is done more as compared to the normal production performance of the company. The amount of fixed production overheads allocated is decreased accordingly so that the inventories are not measured above the cost. This is again in contradiction with what we are actually doing presently as per our cost accounting standards. So we have to keep this differentiation in mind while we do the valuation of inventories under ICDS. Now, coming to the joint products costing by product treatment, where a product process results in more than one product being produced simultaneously and the costs of conversion of each product are not separately identifiable, the cost shall be allocated between the products on a rational and consistent basis. Now, rational and consistent basis has not been defined anywhere in the ICDS. So this you have to do as per your professional wisdom and judgment, as you are already doing while doing the cost accounting under the extent rules. Where byproducts, scrap or waste material are immaterial, they shall be measured at net realizable value, and this value shall be deducted from the cost of main product. I think the same treatment we are giving in our cost records. Whenever some byproduct, scrap or waste material is coming out in a process, we determine the realizable value of that, NRV of that, and basis the NRV, we give the credit from the respective department or process, and this value is accordingly reduced or deducted from the cost of main product. So no change here, same. Other costs shall be included in the cost of inventories only to the extent they are incurred in bringing the inventories to their present location and condition. I think this we have discussed. We will discuss in detail in the coming slides. Interest and other borrowing costs shall not be included in the cost of inventories unless they meet the criteria for recognition of interest as a component of the cost. What do we mean by this? Unless they meet the criteria for recognition of interest as a component of cost. This we will learn in the coming slides, as specified in the ICDS standard on borrowing costs. So this has been dealt in detail in the ICDS standards. Now, let us discuss the exclusions from the cost of inventories. So while we discuss these exclusions, most of the points which we have left in between will get cleared. In determining the cost of inventories, the following costs shall be excluded and recognized as an expense of the period in which they are incurred. Number one, abnormal amounts of wasted materials, labor, and other production costs. So these are the same as we do. Abnormal expenses, abnormal costs, and abnormal consumption of inputs during the manufacturing are not allowed as a part of cost. Rather, they are taken into reconciliation statement as unabsorbed expenses. So in treatment here, storage costs. Now this is very, very important here. Storage costs, unless these costs are necessary in the production process prior to a further production stage. Now, what do we mean by storage costs? What do we mean by inventory carrying costs? Now the question arises here whether these costs will be included in the cost of inventory or not. Generally speaking, as per the accounting standard 2, In fact, I was discussing this aspect in one of the corporate also. They say that our AS2 and our auditors will not allow us to include the storage cost as a part of the value of inventory for doing the inventory valuation. But ICDS in some cases requires that the storage cost be included, provided these costs are necessary in the production process. For example, some of the raw materials are to be kept in some ambient temperature, or even the finished goods are to be kept in some ambient temperature. For example, there could be food items who have got very limited shelf life. There could be some industries like pharma industry where some of the inputs are to be stored at some ambient temperature. Otherwise, their effectiveness or their what you call the quality will deteriorate. So these cost of storing these items in particular conditions or in particular temperature, whether that cost, this could be a significant cost also in some cases, whether this will be included in the cost of inventory or not prior to a further production stage. It is talking about the prior to the further production stage. And what about once these products have been manufactured? For example, ice cream. Now, ice cream, if once manufactured, it is lying in the inventory in the company, it has to be maintained at a particular temperature, otherwise it will deteriorate. Now the question arises whether this cost will be included, the storage cost will be included in the valuation of inventories under ICDS 2 or not. The answer says yes, it will be included. Administrative overheads that do not contribute to bringing the inventories to their present location and condition will not be included. Now again, here we have a challenge. As we know that overheads are indirect expenses. These are not directly related to the product or the activity, but they are indirectly supporting the activity. Now, identifying an indirect nexus between the two may be difficult in certain cases to identify and also to prove. So under these conditions, it may be very challenging to include certain overheads categorized as administrative overheads. Selling costs essentially are post-production costs. So these are never included in the valuation of inventories. So we also do that way. Interest and other borrowing costs. So these are those costs, finance costs, interest and borrowing costs shall not be included in the cost of inventories unless they meet the criteria for recognition of interest as a component of cost. Now, what do we mean by unless they meet the criteria for recognition of interest as a component of cost as specified in the income computation and disclosure standard on borrowing cost? I think this has been made clear here that we have a separate standard ICDS on borrowing costs. So that standard clarifies in what cases. So we need to read this standard very carefully since I will limit my discussion to ICDS 2 only. So I will not detail much on this, but it has a reference to ICDS 9 where it is clearly mentioned in what cases this will be treated as a component of cost and in what cases it meets the criteria for recognition of interest as a component of cost. So only on those cases where it is which is eligible, it is allowed, then it is to be included in the cost. Otherwise, the borrowing and interest costs are not to be included as we do in our normal practice. Now, coming to the cost formula, the cost of inventory items that are not ordinarily interchangeable, goods and services produced and segregated for specific products or projects shall be assigned by specific identification of their individual costs. I think this is clear in itself. Specific identification of cost means specific costs means where there is a clear one-to-one correlation between the cost incurred and the inventory item. So these are specific costs which are attributed to identified items of inventory, maybe bill of material, job charges, etc. Where there is a large number of items of inventory which are ordinarily interchangeable, specific identification of costs shall not be made. Now, coming to the FIFO first in, first out and weighted average cost formula, I think this is the same which we are, since the time already is overshooting, so I'll not be able to detail much on those areas where we understand. FIFO and weighted average methods are two methods which are allowed. Same two methods are allowed here also. Cost of inventories other than inventory dealt in previous slides of specific identification shall be assigned by using the FIFO method or weighted average cost formula. Now, coming to the technique for measurement of cost, it talks about the two techniques, standard cost method or the retail method. This can be used for convenience. Standard cost takes into account the normal weeks of consumption, normal levels of consumption of material, supplies, labor efficiency and capacity. These are regularly reviewed and if necessary revised in the light of current conditions. The retail method in contrast can be used in the retail trade for measuring the inventories of large number by rapidly changing items that have similar margins and for which it is impractical to use the costing method. So in case of large number of items which are generally dealt in the retail trade, mostly for the retailers, I would say this method would be applicable, and for manufacturers the other method would be applicable. The percentages used takes into account or consideration the inventory which has been marked down to below its original selling price. An average percentage for each retail department is to be used. That we know that we do normally in the costing. We determine the shop wise overheads or the absorption rates and accordingly we do the valuation. Now coming to the sir, how much time do we have, sir? TRD department.
Sir, we
Anybody?
are
Overshot.
yeah, already
10
it's
minutes.
overshot.
But 10 minutes, I think we should be able to close by.
Oh, so I think this session takes a longer time to actually do because it's such a lengthy subject. Anyway,
Right.
I would try to sum it up. NRV we understand is more or less the same that we generally understand.
Oh, Ravi sir.
Yeah.
So you
Ravi
keep
sir.
on
Yeah.
going, sir.
Sir, go to the back slide. Sir, go to the back slide. Sir,
Which
that
one?
there item by item was there. Back slide.
This one.
Back. इससे पहले वाला. Yes. So, sir, next one. Yes. This is important one. Net realizable. Sir, net realizable value in red there. Font is red.
Now, net realizable value, as we have discussed, is very important because net realizable value shall be based on the most reliable, because this is very problematic also. Now, as an outsider, when you have been assigned a job or work of doing the valuation of inventory, and you go to a particular company or SSC, how do you know what is the net realizable value? Whether the realizable value which has been considered for valuation of inventory is just and proper or not. This becomes very challengeable. Now, net realizable value, as it suggests, shall be based on most reliable evidence available at the time of valuation. Now, the question arises that what could be the various avenues which you can consider as to be your most reliable evidence available at the time of valuation. Maybe this reminds me of the excise era, where the valuation was done on the basis of apple to apple comparison, most comparable products reliable value. Suppose one company is doing a toothpaste in a X brand, another company is doing a toothpaste Y brand, and what is the compatible brand of that other company and at what price it is being sold, since we are in a very market competitive world. So can we take that as a basis? Can we use that as a methodology? Number one. Number two could be that first point of interaction would be the company as to you will ask the company as to how they have, on what basis they have taken the realizable value. So this realizable value could be the value realized over a period of time actually. Suppose you are doing the valuation at the end of the financial year. How would you consider the realizable value at that point of time? So this becomes very challengeable at times. The estimate of net realizable value shall also take into consideration the purpose for which the inventory is held. Now, what do we mean by the purpose of inventory it is held? It is generally held in the business for sale. So you will refer to the realizable value of the product. What could be the other purposes for which the inventory is held? That you will have to keep in mind. The estimates shall take into consideration fluctuations of a price or the cost directly relating to events occurring after the end of previous year to the extent that such events confirm the condition existing on the last day of the previous year. What does it mean? Estimates shall take into consideration the fluctuations of price that have happened or costs that have happened, which are directly relating to the events occurring after the end of the previous year. For example, some abnormal situations of corona pandemic has spread. So due to the spread of the corona pandemic, many of the items which used to sell at a big volume, all of a sudden stopped selling. So there was a huge drop in their selling prices. So are we referring to those conditions which are impacting on the selling price or the cost price of the product? On the other hand, the input costs of many items skyrocketed. So at what cost the valuation? Somebody asked me in this in one of the discussion, somebody asked me that what should be the date at which you should do the costing? Like if you are appointed to do the valuation of inventory, suppose in X day or on X month or X date, but you will be asked to do this valuation for a date which is prior to your appointment, maybe months or years back. So how would you actually ascertain the situations prevalent at that point of time? Because you have to have a bearing on the conditions or events which were present or which occurred after the end of the previous year, which had some bearing on the cost or realizability aspect of these products, because these are very important for you to do the valuation. So these are some of the challenging situations which you are going to face. I think we need to deliberate more in detail on these aspects since time available here is very short. So and it is more of a one-way platform. So we need to organize more such workshop where we have open house discussion on these aspects. Materials and other supplies held for use in the production of inventories shall not be written down below the cost, where the finished products in which they shall be incorporated are expected to be sold at above the cost. Now, this is again challenging, where there has been a decline in the price of materials and it is estimated that cost of finished products will exceed the net realizable value. The value of material shall be written down to net realizable value, which shall be replacement cost of such materials. Now, it may be really very difficult to ascertain the replacement cost on a backdate basis. So this is again an area which is very challenging even for an ascertainment of NRV. And NRV in turn is very important in ascertainment of valuation of inventory, because you have to have valuation at the lower of the two, cost or net realizable value. So that way it becomes very challenging. Now here is a list which is, I think we are at the fag end of the presentation. This is very important, although differences in the ICDS, IGAP and IND-AS, because the organizations are already following in GAP, IND-AS and Indian GAP and IND-AS, AS2 for valuation. So what are the differences? ICDS talks about the cost of purchase consists of purchase price including taxes. I think this we have discussed, but these taxes are not included in the two methods. When the actual level of production approximates to normal capacity, fixed overheads are allocated using the actual level of production. Whereas other methods, actual level of production approximates to normal capacity, fixed overheads may be allocated using the either actual level of production or the normal capacity. I think the same situation is present in our cost accounting standard 3 to cost accounting standard 3, Redwood case 2, which talks about the capacity determination and allocation. Interest and other borrowing costs are included, but here It is more or less similar, but cost of inventories include purchase price for deferred payment terms unless interest element is specifically identified in the arrangement. So this is very rarely done. But here the interest and other borrowing costs in ICDS are included in the cost of inventories if they are allowed as per the ICDS standard on borrowing cost. So this is again in contrast with the in GAAP and in AS provisions. Now, retail method can be used in the retail trade when it is impractical to use the costing method such as FIFO or weighted average. But here standard cost or retail method can also be used for convenience. Now here in the ICDS, replacement cost is used to measure the net realizable value in circumstances where value of material and other supplies is required to be written down to net realizable value. But in the other two methods, replacement cost may be used as the best available measure of net realizable value in circumstances when value of material and other supplies are required to be written down to net realizable value. Then only the replacement cost method should be followed. Regarding the reversal of written down value, no provision is sorry, is guidance given in the ICDS. Now another list actually gives the comparison about the cost of services. As per ICDS, it is included. As per AS2, no specific mention of the cost of services is there. Sorry. Exclusive versus inclusive method. In the ICDS, it is mentioned that the inclusive method is to be followed, where in other standards, exclusive method is to be followed. Other costs includable in the value of inventories, ICDS 2 does not specifically exclude distribution costs, but AS2 also exclude the distribution. AS2, I think this is the situation is more or less similar about the this valuation of and inclusion of distribution costs so far as it relates. I think this provision is more or less the same. Value of inventory at the beginning of the previous year. Now here is a contrast. New business, it should value at the cost at the day of the commencement of the business, and continuing business should do the valuation of closing inventory at the end of the preceding previous year. There is no such specific provision. Valuation of inventory and interest and other borrowing costs. Interest and borrowing costs should be included as we have discussed earlier. Valuation of inventory in certain cases. Now this is a unique case here. In the case of dissolution of partnership firm, the valuation has to be done at the NRV only. It is not to be done at the lower of cost or NRV. Whereas in the AS2, this is to be done at the lower of the two. So I think this is it contrast. With this, thank you. This presentation has come to an end. Now this is time for any questions you have.
Thank you, Raviji. Thanks a lot.
I think we have already
presentation explained in detail.
I had to run through all this, Navneet ji, because time was very less.
Kind of short. That is okay, but
Yeah.
we will have soon some physical sessions also. The first thing is that because we cannot go to all the places, so that is why we are keeping the webinars. So a few more webinars will be there, then we will be going in for physical session. Maybe I'll request NIRC to have few physical sessions over here. And we are having few sessions physically right now. I'll be going for a session to Ranchi on 17th, I think. Yeah, on 17th there is a session.
Yeah.
So many Havana has conducted, organized Havana, Guwahati, everybody has organized physical sessions. In North, it is less as of now, but certainly we will go in for more physical sessions here soon. So my request to all of you, if any query is there, so please mention the query over here. Otherwise, we will be requesting our.
There is one question from Tapas Sarkarji. Depreciation as per Income Tax Act included in inventory. It is to be considered for ICDS 2 valuation. Yes, definitely. Depreciation has not been disallowed as a cost there. What do you think, Navneet ji? Tapas Sarkar.
Tapas sir has given a very different question, and it is in our mind also.
Okay.
What happens while computing the tax? What happens? A different set of depreciation is used. And while computing the, you can say, profit and loss account as per, you can say, Companies Act, a different depreciation is used. He has rightly asked, because nowhere it has been clarified that which depreciation is to be used. Whether the depreciation which is being allowed under the Income Tax Act, whether that is to be used for computation of inventory under the Income Tax Act, or whether the depreciation
Companies
which
Act.
has been used in the Companies Act, whether that has to be used. So for a still date, let me tell you, everywhere depreciation as per the financials is being used.
Yes.
Right. So we have to go by that. Now let us see to it when we will be having few interactions with the department, and maybe we come out with a specific clarification, because if it happens, if we are going to change that with the depreciation as per the Income Tax Act, because that is purely for the purpose of computation of tax, it will unsettle all the things. And I don't think this is the right time to go for unsettling the things. Let us try to move gradually and later on, because so many things are there which are under the Income Tax Act. There are some weighted deductions are there, some deductions are there. Then question will come on each and every aspect of under the Income Tax Act. That is why we will be, you can say, specifically going in for depreciation as per the Companies Act, or depreciation as mentioned in any other act. As of now, later we can just discuss on these aspects.
Navneet ji, my point is that while the companies prepare they recompute the tax liability or taxable income, they already account for the difference between the depreciation as per Companies Act and as per the Income Tax Act. So better you follow the depreciation, because that in any case in totality they are taking care of that.
In totality they have taken care.
So I think if they have taken care, that will get automatically reversed. So if you follow the rates as per Income Tax Act, then again it will be challenging for you. I mean,
that is why we are going ahead with the situation which is existing as of now. But yes, it was discussed. It was discussed at the top level, and they were also okay. What is to be done? Then we had said, let us move ahead, and then later on we will see to it, because so many questions will come. Till date, nobody had you can say get into the inventory valuation in so much of details. Now we have started. This is just a beginning. Let us see to it. How do we proceed further?
Many a times somebody raises me a question, even I have not thought that way, so I have to think upon as to how to, deal with this situation. So this is this is still, very early stages. Although the orders are about to happen and we may be assigned the work soon, but still we have very less time. Another question has come from Kamal Kishore ji. How many numbers of period can be taken for normal capacity? Ideally 5 years period, or maybe 3 to 5 years in my opinion. What is your opinion, Navneet ji?
Ramiji, that is a generic thing, but when we talk about ICDS, it doesn't mention anything. However, in our guidance note, it was somewhere mentioned. But again, we will see to it how to go about it. But if strictly following ICDS 2, they have not mentioned any periods.
Okay, so I think we can be guided by our own standards in absence.
Yes, that
so long as there is no contradiction, we can follow our standards.
Yes, certainly.
Okay, so any more questions, queries? I'm scrolling through. I think all of the participants, they are thanking us. Thank you for joining us and making this happen. If any more specific questions are there, you may please write us. So we will definitely try to take up these in our next session. What do you say, Navneet ji? I think we have to have.
We will be having a few more sessions on ICDS. No, this is a general ICDS 2 we have done. We are planning to have purely practical session, but we are thinking of going in for a practical session in physical mode rather than on a webinar. So let us see how do we proceed. But if we go with the physical mode session, only you can say 100, not more than 100% will be available at a particular stage. Through this medium, we can you can say have session across India and persons from across India join the session.
Yeah.
We'll see to it how can we go about that. My request to all the audience, whatever the medium they feel comfortable, they can just try to trd@icma.in and we can plan accordingly. Then.
Definitely. And please try raising more and more queries, because that will give us a, I mean, way to, I mean, discuss in a different way, and also to look out to fetch the solutions. Maybe more clarity will come, more of the questions will bring in more clarity, more
Raviji,
discussions.
Raviji, sorry, first. Just please complete, Raviji.
Okay.
Because
I think what I was referring to was that we should encourage more and more questions from the participants,
yes,
because
sir,
more
sir.
question coming in will inculcate into more discussions, and this will result in a better clarity for all of us.
So Raviji,
So
RC Mittalji has asked one question. Can a part-time COP holder can inventory valuation do? Look, inventory valuation,
no,
if under section 142(2)(a) is there, no. But certainly, if any organization approaches that person, he can do the inventory valuation, but not under section 142(2)(a),
correct.
right? And then is how proactively organizations should prepare to address the ICDS. Organizations are already, you can say, have already following the ICDS, but somehow they need to improve upon the system. That is what.
Ramesh ji has asked about the normal capacity is to be understood as the operating capacity. Normal capacity is the achievable capacity over a period of time, as we have repeatedly discussed.
Practical capacity would normally practical capacity after you can say giving deductions for different type of you can say holidays and another things. I think it is that.
For example, your installed capacity is say 100 tons, practical capacity is say 80 tons, but you have not been able to achieve more than 50 tons over a spread of say 5 years.
Spread
So
then normal
then
capacity.
50 tons becomes your normal capacity. This is the concept.
It is based on our you can say best three out of last five. That is what is being talked about.
Yeah.
So different.
Capacity is complex for multi-product company. Yes, it is there. Then you have to depend on the machine hours and equipment hours. Because nowhere in the ICDS this is mentioned. You can be guided by your own standards, which actually talks about the equipment hours in the for measurement of capacity.
Sir, Kamal Kishore has asked one very good question. Will department accept our opinion regarding number of period? This is a big question. We also have a question mark on this thing, whether they are going to accept that or not, because we have to follow religiously ICDS too. And when we will go with this thing, they may come up with that why we are following that, and then we will have to refer to our not cost accounting standard, but guidance note on cost accounting standard, because even our
Yes,
cost accounting standard doesn't mention about number of periods. So this is a
definitely.
big question as of now. So let us see how can we, because until unless we do that, the way Raviji has suggested, that if an organization for the last 3 years out of 100 ton of installed capacity is using only 50, whereas the practical capacity is coming as 80 ton, so practically 50 ton will be his normal capacity, because he's increasing expenditure for so many years only
Yeah,
for that 50 you can say 50% of utilization. So
definitely.
I believe that that should be the
Guiding
reasonable
principle.
thing, guiding principle. Let us see how can we go. We will have a discussions with the department on those things, because by doing that thing, our inventory valuation will increase more. Let me tell you, because we will be, rather than excluding the expenditures, we will be including that. So that thing is going to, including 85. Yes, no.
Okay.
I think I'm telling reverse thing. I'm telling reverse thing, sir. If
Yes.
I'm not mistaken, I'm telling the reverse thing. Other more expenses will be. No, sir. I'm telling whatever I'm telling, that is correct. Because our then normal capacity will be lower now. If my normal capacity becomes lower, my more expenditure will go into my capacity utilization will be more. And then my more expenditure, more fixed expenses will go into the inventory valuation.
Definitely. Whenever your base is small, the more you will end up loading more cost.
Yes. Next
So,
one is, do the semi-variable cost to be bifurcated? Try to bifurcate that.
I think
And,
nowhere in the ICDS there is a requirement to bifurcate. They have simply,
they have no, we have to segregate between the fixed and variable. So that is why if semi-variable is there, fixed and variable need to be bifurcated practically. Otherwise, semi-variable word is not there in the ICDS too.
yes, it is not there. It is not there. They have
How
only
to-
mentioned that some cases the cost may increase proportionately or may not increase in the same proportion.
Yes.
So this is what actually they're talking about, the semi-variable cost actually, in essence.
Raviji, one
How
more
to-
question is there. How to read provisions for non-moving stores? Mahatoji, there is whether did we discuss in detail ICDS 2? Did we discuss provision of non-moving stores? It is not there. Straightway they are talking about NRV. That's it. That is why in my initial, you can say, address, I specifically mentioned that one of the company was doing some sort of provisioning for the financial purposes, financial profit purposes, and for the purpose of computation of profit for the income tax purposes, they used to reverse this provisioning.
I think
That is what they
he
used
must
to.
be, Navneet must be asking as to whether this cost will be included in the inventories or not. The cost of non-moving stores. Because when we make a provision, we incur a cost, actually book a cost in the P&L. Whether that will be loaded onto cost of inventories or not while doing the
Sir,
valuation.
here again two questions will come.
Hmm.
One is stores which are lying as a inventory, closing inventory. They are non-moving, provision for non-moving, whether it should be there or not. Second, whatever you are telling. So as and when we will keep on discussing, more and more things will keep on coming.
I think this falls in the category of abnormal expenses, which are expressly explained not to be, allowed as
Included
a cost.
it has been explained in that. But for the if any stores is lying in the closing stock, provisioning this type of provisioning, we need to check with the ICDS too.
Gautam ji is asking how to get empaneled with the IT department for inventory valuation. I think you have already explained that the notifications have come from various commissionerates, so you have to keep a vigil.
More and more are online. Valuation of WIP not mentioned. Krishna ji, question is not clear. Goods in process is already there in ICDS 2, and it's specifically how to work out the NRV of that. Even that has been mentioned.
Valuation of inventories, we have not, WIP, I think we have missed out, we have not touched upon. So WIP valuation is a most.
It is there in ICDS.
It is there in ICDS, and it is a specialization area for cost accountants actually. So it talks about the stage-wise valuation, stage-wise completion also. I have read it. So it talks about that. So it is a very, very systematic valuation you have to do for WIP.
Sir, we
So
can complete. We have overshot. We have doubled our time, sir. So please try to close, sir.
Yeah.
Many
Thank you
questions
very
are there.
much.
We are happy. Many questions are there. So over to you, Rajat ji. I think we have answered almost all the questions, whatever were there. Over to you, Rajat sir.
So much, sir.
Thank you so
much. Thank you, Ravi ji, for beautiful presentation. And yes, the time was very short. We will have to have a separate session, another session on this. And many thanks to Navneet ji for being with the department and organizing such seminars on a regular interval. So from the responses and queries of the participants, we are clear that we need to have some more webinars like this, and we agree with Ravi ji that as much as possible we have to increase the interactions, and if we get more questions, more clarity will come. So we'll be having more sessions like this. Again, we want to say thanks to both of you, Navneet ji and Ravi ji, and thanks to all the participants for being with us in today's webinar. Thank you so much. Thank you. Namaskar.
Thank you. Thank you. Namaskar.